All right. I mean, back to the target of 5150 for next year, Liz. Yes, granted, if you get a little bit of a run between now and the end of the year and, okay, you reduce the expected 9.5% upside down to 7, I think some people would say, hey, I'll take that in an environment next year where you could have multiple rate hikes, right? I mean, that's the difference in the environment between now and in the last year or so. We've obviously done great in the S&P 500 because of all the stimulus, all the liquidity. You take that away, you start raising rates, and you can still put 7 to 7.5% on the board. I think people would say, I'll take that.
Well, I mean, even in the worst case scenario that the market was pricing in, let's say we had 3 rate hikes next year, that's still a pretty low rate. And we're coming off zero for the first time in a really, really long time. I also think the market is a little ahead of itself. I don't think we're going to start seeing aggressive rate hikes in June or July. I think it gets pushed out a little bit further. But I also want to go back to another momentum shift that's happening, and that's just a shift in sentiment. And the idea of, if you look at everything that's led the market, if you look at the first year of this recovery, right, or the rebound phase, we had really concentrated strength in the market, which was great if you held those concentrated parts of the market. But now we've had this broadening out, which as an investor makes us all feel a little bit safer because you can have a diversified portfolio and there's multiple points in it that are going to help your returns. Whereas when you have really concentrated parts of the market, like FANG stocks being the only big leaders, you get worried that what happens if those fall apart? Now there's a lot of stuff that would have to fall apart to really send us in the other direction.
That's why, Doc, I go back to what Liz is sort of leading me into is the Tom Lee everything rally, right? That you've had a broadening out. And as he was with us on this past Friday, and he's been right, he thinks you get a lot of different sectors moving up over the next, whatever moment of time you're looking at, few months minimum. Energy, home, these are his recommended strategies. Energy, the home builders, the small caps, his so-called epicenter names, those being things like financials and industrials, crypto, et cetera, right? So this broadening out of a rally has put a nice pillar of strength underneath the market.
Absolutely, Scott. And it means that the FANGs don't have to carry the load. And you've talked about it, and we have as well, about the passing that torch from sector to sector. And it's why we have seen pretty significant corrections in a given sector, only to see then another leadership position like energy, like financials, step in. And right now, there are several new ones. We'll talk about it in the next block, but there are several new ones that are just on fire right now. And it's where really the smart money is being put on the table in a big way by institutions. Yeah, by big institutions, big block buying of calls as well as stock in some of these other new sectors that haven't been noticed quite as much until now.